All right, let's see. The streams are both up. Good morning, everybody. How are you? I hope you like my new setup here. I've decided that because I'm so annoyed with my current camera and that setup that I'm just going to blur my face out for a while. So some of you will say, "Hey, don't do that." Many of you will say, "Good." So regardless, you guys, I hope life's going smoothly for you. This is another Derks Financial client portfolio update here. Two things before we get started. As always, first off, this is not investment advice. If you guys want investment advice, you need to call my office for investment advice. Secondly, this live stream is brought to you by Derks Financial. If you are a business owner and you cannot stand doing all of the back end stuff on your own, you need to call me. Accounting, bookkeeping, payroll, all taxes, and a lot of strategic investment advice on how you can continue writing off different items and keep your business extremely, extremely profitable. So don't forget, comments in the comment section. I monitor the comments as I'm doing this, and I'll chat with you if you want to chat with me. Any questions on any random stocks or news things that you've heard. So, oh man, you guys, there's been so much stuff coming up that I wanted to go over with you. Okay, let me see here. So we talked about, I'm going to pull that out, pull this out. All right. So just to be on the same page here, World Economic Forum says fashion will be abolished by 2030. Humans will all wear a uniform. Is that actually real? It is. It is actually real. That's not a joke. So like it wasn't, you could understand where they're going to come at you with, "Hey, you can't drive cars. That's bad. Hey, you can't eat red meat. That's bad." Like that stuff is stupid, but okay, fine. But you can't even have fashion now? Um okay. I'm not even going to read the article. It's so ridiculous. Okay. Um Here's the actual article I wanted to show you guys. Firstly, the debt time bomb is ticking. Rising delinquencies, soaring bankruptcies, and the looming detonation of student loans. Oh shoot, I can't get it. There we go. Yeah, the number of bankruptcies are exploding across personal bankruptcies and corporate bankruptcies, which is pretty shocking. But right here, the 2,973 total commercial Chapter 11 bankruptcies filed during the first 6 months of 2023 represent a 68% increase over the 1,700 filed during the same period in 2022, according to data provided by Epic Bankruptcy, the leading provider in U.S. bankruptcy filing data. Chapter 13's also increased 23% in that same period. So let me scroll down here to the two. Yeah, here we go. Here's the summary. Bankruptcy filings, both for businesses and individuals, have significantly increased in the first half of 2023 compared to the same period in 2022. I try to show and only set up for things getting worse come October. What is it that comes October? Oh, that's right. Gosh dang it, this guy's terrible at linking stuff. I'm sorry, everybody. That's right. The student loan situation is all going to start up again. So you've had 3 years of no student loans, and if you miss payments, your interest is going to just keep racking up. And I believe, if I'm not mistaken, you're going to have all of those 3 years of interest added on, but I could be wrong, so I won't even go down that route. And then here, reminder: while banks have liquidity fairy, we get the promise of 2 more rate hikes this year. To fix one end of the mandate, price stability from inflation, they created, the Fed will continue sacrificing employment. Again, they keep raising rates because they want unemployment to come up. So anyhow, that is a very bizarre little situation that we're in. You know what? I'm just going to keep going because this article is kind of, it's really just somebody's post on how messed up things are at the moment. But, you guys know that. I don't have to, preach to the choir here. Let me have a look. Ah, yes. Okay. Thank you for being patient. This is what happens when you have a one man show. Somebody who is doing his own what do you call it? His own show prep. I guess is that the phrase? My own show prep. Okay. Breaking. Breaking. Canada fixed their housing affordability problem. The solution is debt slavery forever. Lenders now seeing 60, 70, and even 90-year mortgages as Canadians struggle with rocketing interest rates. You guys, 60, 70, and 90-year mortgages is unreal and unheard of. In America, even the 30-year mortgage is kind of a new thing. It used to be a 15-year mortgage, and then it was only like I don't know, maybe about 10 to maybe 20 years ago or so, they started doing 15 or like 30 years. If you think real estate is bad in America, and it is nothing compared to Canada. Canada for, oh gosh, now somewhere between 5 and 10 years now has had open season on Asian investors coming in and buying up as much real estate as they want. And they basically put no limitations on it. And so Canada real estate has had a ton of new rich from specifically China, but Asia trying to get money out of Asia and into the West. And so here you go. This is the problem they're seeing now. So let me read this a little bit of this to you here. Some banks mostly offered fixed payment variable mortgage, which allows homeowners to keep monthly payments the same, but leaves them vulnerable to paying little of the principal. Keep in mind, if you have a 90-year mortgage, all loans, you know what sucks about taking a loan is that like the first half of the loan, something like 80 or 90% of what you pay each month is going just towards interest. Imagine if you have a 90-year mortgage or even a 70-year mortgage. You're going to be paying interest almost essentially your entire life. And then when you die and your children or whoever take it over, then what? Maybe you have a life insurance or something, but um, right here, the majority of mortgages at some of the major banks are being extended and homeowners are getting concerned. Yeah, no joke. Not only that, but let's see here. Do I have interest rates? What are interest rates right now in China? Excuse me, in Canada. They might as well be China. Um, and we know that they're raising interest rates as well in Canada. Canada interest rates. Let's see. It just says that they're continuing to rise. Oh, here we go. So 4.75, it could be 5% interest. So let's do a home loan calculator. All right, so let's just say we're buying a $500,000 house. Oh my God. Excuse me. The calculator doesn't even allow you to put in a 60 or 70 year. Yeah, it won't. Oh my gosh, this is crazy. I can't choose on any of these calculators. Here, years. Okay, we're gonna do a 70 year, 500. We're poor, so we're only doing 10,000 down. Interest rate at 5. So yeah, we'll do 6.5. That's probably about right. Uh, calculate. Okay, I think I broke the calculator. So you guys, whatever. I'm trying for you. You know, I'm trying, but it's not gonna work. It's not gonna show us. So bottom line, this whole uh, this whole drama here of lenders in Canada are doing 60, 70, 90-year mortgages. This, my friends, is not a sign of a healthy economy. This, that's that term, a healthy economy. So now let's check this out. Brics. Oh, here we go. I'm sure you guys have heard of this. Let me copy and so let me play this for you. Breaking. Russia confirms that they are launching Brics current let me restart that. Breaking, Russia confirms that they are launching a Brics currency backed by gold. It will be on the agenda at the Brics South Africa meeting in August. Many other countries have applied to join Brics. Let's hear what they say here.
The BRICS group is set to introduce a new currency backed by gold, in contrast to the credit-backed US dollar, with countries lining up to join the growing initiative.
The BRICS countries are planning to introduce a new trading currency which will be backed by gold. More and more countries recently expressed desire to join BRICS.
The decision comes a month ahead of scheduled Alliance Summit in Johannesburg, South Africa. 41 countries have since shown their interest in BRICS membership and its new currency implementation. Russia's foreign ministry has stated that if African states show enthusiasm, the group's expansion may also be on a Russia-Africa summit's agenda in the end of July. As of now, the BRICS group remains comprised of Brazil, Russia, India, China and South Africa. Former statistician general of South Africa, Pali Lehola, says the gold-backed currency will facilitate the advancement of developing countries.
All right. So you have half of the second world and third world countries are trying to get on this. Now, here's the thing, you guys. And here's one more tweet on this. But what I like about Twitter is this community notes thing. So here's this Kim.com guy, this New Zealand hacker everybody knows. BRICS Plus will announce a new joint currency backed by gold at the August summit. It's the end of the US dollar backed by nothing, which is true, as global reserve currency. The end of endless US money printing on the backs of other nations and the inevitable US economic collapse under its enormous debt. Okay. So, like, let's be straight. Kim.com here, he's got a good point. It's true that the US dollar is backed by nothing, just IOUs. It used to be backed by gold in the 70s. We left that entirely. But honestly, you guys, for those of you who have, let me put it this way, for those of you who have traveled and backpacked or just traveled around the world, and I don't mean to like Paris or London, but I mean if you've gone to some rough places in Asia, in West Asia, like good example, Turkey. If you go to Turkey right now and their currency is the lira and you try to pay with a US dollar, they're going to say, hell yes. The US dollar is not going anywhere yet. Now, let's just say in the best case scenario for this BRICS gold-backed currency, if it really took off, that's BRICS. Brazil, R is Russia, I is India, C is China, S is South Africa. So that's BRICS here. Plus all the other countries that want to join. If this actually happens and they all started doing this, okay, then you have some real concern for what could happen. But honestly, I don't think that this is going to explode and destroy the dollar like this year or something. And even here, the context, it says, on July 5th, CFO of Brics Bank confirmed there are no plans anytime soon for a BRIC currency. That doesn't mean they're not working on it. They could, but there's nothing to be gravely concerned about just yet. While there are some press reports that a BRIC currency announcement is imminent, most reports state that such currency is far from being reality, and that's pretty much maybe in a year or 2 or 3 years, very possible, but it's just not going to happen yet. But regardless, this wouldn't even be a conversation on the table had the United States and the global greed not gotten to be so immoral and unjust. Just like this. Now, like for example, I said a minute ago, if we hadn't left the gold-backed currency that we used to have, this wouldn't even be an issue. If we hadn't gone to Saudi Arabia and pledged the full force of our U.S. military in exchange for them only using the dollar for oil, called the petrodollar, this wouldn't even be a thing. But decades and decades and generations of corruption and self-serving has got us to this point. So unfortunately, here we are. But, we'll see how that pans out. So be patient, you guys. I wouldn't freak out just yet. Now, with that said, let me click that out. Stock market, it's an okay day unless you have tech right now. Tech is down, but everything else is doing kind of all right today. Okay. You guys, we talked about this on one of the last episodes. Talked about it on episodes before that. This article from Zero Hedge here. And I'll start with this one. You are being lied to. You're being lied to on every single front right now when it comes to the various data of the US economy and how good or bad it is. For example, payrolls every month for 2023 have been revised lower. What does that mean? Well, first, they say what they expect it to be, and then they release the numbers, and then a couple weeks later, they revise the numbers once they are all in. And you can see right here that every month this year we've been revised upside down and lower. In fact, that's not even new for this White House. You can see on the left of this chart where there isn't a red circle that the same thing was happening back in 2021. You can see that right there. Don't you guys remember back in December when they said something like, hey, we added 200,000 jobs, and then they revised it and they said, oh, you know what, now that we got all the actual numbers, we actually lost 15,000 jobs. So this is just complete fraud. It's not a good sign, and it builds on this other tweet that I want to show you right here. And honestly, well, let me forward this as well. So here is to build on what I just said before I show you this video. April revised down by 77,000 and May revised down by 33,000. So how does that happen? Well, people sit in an office and they take all the data they have and they just try to make some general assumptions about where they are. But I don't know about you, but it seems like at this day and age with the internet and the amount of technology we have, your estimates might be off by 5 or 10%, but how in the world 5 months or 6 months now in a row are you so wrong and so drastically wrong? It doesn't make sense. This goes right in line with the CPI data. If you remember, we did a video about the CPI data being changed back in December, and what do you know? CPI is slowly trickling down, but they perverted the calculation of CPI so greatly that the only thing it can show is that it's going down. So CPI, the amount of inflation that you are all experiencing, increased rent, increased food, increased everything. The way they used to calculate that was on a rolling 24-month calendar. So you had to take inflation for 24 months ago compared to this month. Well, what they did is they perverted that and they said, oh, we're just going to scratch that and do just 12 months now, which is a complete perversion of the entire algorithm and the entire purpose of it. And so now they are able to say, like, look, we're killing inflation. We're winning the fight on inflation, just like we won the war on drugs, and we won the war on terror, and we won the war on poverty. We're going to win the war on inflation. So you guys, this is just another data point for you to see that right now you can't take much seriously, and that a lot of things on TV do not match reality in your own world. And I think you know that to be true. So, okay, let me see real quick. Let's have a look here. Anything interesting on CNBC?
Chinese government has suggested that their position is still unmoved. In fact, the finance ministry today said that China now requires U.S. action on Beijing's concerns. Those are the next steps, which would include canceling additional tariffs on Chinese goods, ceasing the, quote, suppression of Chinese firms via sanctions or export curbs, and also lifting the ban on Xinjiang products. But whatever happens in official circles, Sarah, to your point, the reaction among the public has been very, very welcoming. She left a very good impression.
So just so you guys know, there's a little trade war starting to bubble up again between the United States and China over chips and rare earth minerals and metals and so on. Time will tell what happens there, but
yeah, we don't use that term officially, but it would be a great title to have. The other thing I noticed today, Eunice, was some ongoing dialogue regarding China-Russia trade commitments, and I wonder how that's playing as we see these ongoing tensions geopolitically regarding Ukraine.
Well, China continues to repeat that it wants to maintain a very close friendship with Russia. It hasn't yet condemned at all.
Okay, so nothing too exciting to be seen on this. All right, you guys, I want to show you. Let me see here. X.
That's manufactured.
Okay, so to to piggyback on what we were just talking about with data numbers, I want to play this video for you with no comment because honestly, the video is so succinct in just 3 minutes, I really can't add more. Check this out.
Fresh U.S. manufacturing numbers took a, quote, sharp turn for the worse last month, now dropping at a 5.3% annualized rate. That matches last year's lows, and both are the worst since the 2008 crisis and, of course, the COVID lockdowns. In fact, this now marks the 8th straight month of contraction in manufacturing, also the worst since 2008. In the latest numbers, both production and employment declined, while new orders, which is a canary in the coal mine in manufacturing, collapsed. Surprisingly, even consumer goods are now contractionary. So manufacturers reported consumers pulling back because of 1, rising cost of living, 2, higher interest rates, meaning higher debt payments, and 3, growing concerns about the economy, as in consumers are afraid of losing their jobs. Finally, pricing power flopped in the new survey, which normally would be cause for celebration in this inflationary age, but in this case, it is companies purging inventory, selling it at whatever price they can get in preparation for a collapse in sales. In fact, sliding manufacturing is now a worldwide phenomenon as contraction in the US and Europe spreads to Asian exporters. Europe's most recent PMI came in even worse than the US, while Europe's year-on-year industrial production is at a 4% drop. Both also the worst since both 2008 and the lockdowns. Of all of the major countries at this point, only China is in positive territory, and just barely. This global manufacturing crunch is hitting global commodity prices, which are now plunging despite ongoing worldwide inflation. So normally inflation should boost commodity prices because they're hard assets, but recession is now overwhelming that. As a whole, commodities are down 12% on the year, while industrial commodities, which are more sensitive to recession, are down 14%. Oil, which is very sensitive to recession, is down 39%. So what is next? I'd expect a continued drop in goods prices as companies liquidate inventory while workers give up on raises for fear of finding another job. The next domino to fall will be services as cost of living, debt, and jobs all hit demand for everything from haircuts to construction. If that too falls, at that point, expect the long-promised drop in core inflation, but not because they fixed inflation, rather because they finally killed the economy. Biden's handlers will no doubt take a victory lap, either because they don't know or they don't care that inflation is being squeezed out of the American people and paid in blood. After trillions in money printing to finance government deficits, there are fundamentally only 2 ways to fix an inflation: shrink the money or crash the real economy. While money supply is now contracting at the worst rate since the 30s, I did a video on this last month, that is still only a tenth of the 40% increase in the money supply during lockdowns, leaving the other 9/10 of money printing to beat out of the American consumer. We are seeing what could be the largest engineered recession in a generation, all to hide the obscene money printing it took to bribe voters into lockdowns. Our leaders are still in denial, but businesses and increasingly consumers are getting ready for a major storm. Okay, we'll be watching.
So, like I said, what more can I really add to that? I just want to break down a few points of what he said there. Well, all those data points that he said in the first half of that video that are falling apart, what he was saying was that is the foundational, those are the foundational metrics of a global economy. The amount of manufacturing orders. You know, you drive through the industrial part of town where there's those big, corrugated buildings or whatever made out of aluminum and whatnot, and they're building massive machines and all that stuff. These are the guys he's talking about here. These fundamental foundational pieces of any economy and how much they're dropping. Then he goes in to describe right there the next shoe to drop, which people are keeping an eye out, would be services. That's the, like you said, haircuts and restaurants and whatnot. That's the part, in my opinion, that a lot of people have been saying for the last year and a half. As you go to the grocery store and you see a box of cereal cost $63, and you say, how in the world are people less wealthy than me getting by? Well, he said it right there. The amount of obscene bribery, monetary bribery, since 2020 is off the charts. I mean, here in the state of Missouri, we had the SAFER program, which basically said, hey, you can't afford your rent, just write us a piece of paper, send us one piece of paper, and we'll pay your rent for the next, what was it, 6 months or 12 months. And that program just ended like 3 or 4 months ago, 2.5 years after COVID, and that program just finally ended. So now that stuff is ending, and here he is talking about, well, the most foundational metrics of an economy are starting to seriously contract. And if that continues and rates continue to rise, you ought to see the consumers start tapping out because they can't afford to buy a new car, buy a new home. He said construction may start seriously contracting. But yeah, going out to restaurants, you ought to see people stop doing that as much. Unless there's free money for them, which, as we know, there are a lot of Americans currently just living off, free welfare. And if you think about it, if I have my rent paid for through welfare, if I have my student, my kids paid through welfare, my cell phone internet paid through welfare, my food paid through welfare, my other various base expenses. Well, heck, if I just earn like $500 or $1,000, $500 a month, $1,000 a month, hey, I could actually like go spend a lot at Chili's for dinner or what have you. So this will be a very interesting development. This guy's actually a very, very smart guy. I like following his videos a lot. He makes very succinct videos. In fact, I may try to copy this style, but yeah, I wanted to show you that because that is manufacturing. The manufacturing numbers are not looking very good, and he had a very interesting point there where that's the way they're going to get inflation down. The way they're going to do it is a trade-off, and the trade-off is killing the economy. That's how inflation will finally come back down, is that people are just simply unemployed, and or if the cost of living is so much that people are just not going to the hairdresser, not going to the restaurants because they're unemployed, they can't find decent work, and the cost of living has become so great. So anyhow, there was one interesting
See you next time.
comment that I wanted to read on this tweet. Where are you? Here. This guy, Douglas Ritz. I have no idea who Douglas Ritz is. So anyway, he says, inventories have been building since February of 22. In fact, storage was a huge revenue stream for warehouses. Europe went into recession in March 22 and then the US in May. It's a rolling recession, and that's why no one is seeing it. It doesn't meet the NBER definition. All the strength that you are seeing in the economy is paper thin in the afterglow of the COVID largesse. That's why the interest rate hikes have not been as effective as hoped. All that capital needs to be soaked up, and it's going to take some time. Yeah, that's a very good point. So we'll see. Now let me pause for just a minute. Let me check the live streams. Let me check my stream health. Okay, looks good. Remember, if you guys have any questions, comments, or any various articles that you've been seeing, put them there in the comment section. We'll talk about, you want to talk about some stocks you've heard about or something? Let me know. I'll be interested to see what you got. Okay, that looks good. All right, very good. So undo this. All right. Now here's something I have a curiosity about that you're absolutely not allowed to question or use any critical thinking. Hey, did you guys see this? Oh, what is this? Bad news for the economy. Real-time disability data. Let me start over. Bad news for the economy. Real-time disability data from the U.S. Bureau of Labor Statistics rose 857,000 in June to an all-new time high of 34 million. The rate of change is accelerating again. If this was a stock, it's a breakout chart and a reacceleration of trend. Both employed women and men hit new highs as well. Hey, does anybody know what happened around the late 2020, early 2021 that might have caused a rocketing of people with permanent disabilities? Can anybody think of why people may have had permanent disabilities? Well, here's another interesting tweet that came out just like in the last day or two as well. Natural cause of death in 0 to 24-year-old persons continue to escalate to excess, now at 32%, up from 26% excess only 4 weeks ago. He talks about 12 sigma, 10 sigma. That's kind of like a standard deviation. It's a drastic increase, essentially. All these charts tell the same story. They all inflect at week 14 of 2021. What? What in the world happened in the 14th week of 2021 that could possibly have caused excessive numbers of natural deaths and really, at the same time, caused 900,000 people per month to become permanently disabled? That's weird. But I'll tell you what it definitely isn't. Without doubt, it is not. Okay, next topic. Get out of here, Ryan. You're going to get yourself in trouble again. Let's see what CNBC has to say for just a second here.
And there's also, there's obviously capital flowing into certain sectors. You're seeing AI and its impact, data centers and places like that. So we're fairly, have a fairly significant infrastructure build. And one last area I've talked about before on CNBC a long time ago, we've been focused heavily on sustainability. And we believe there's going to be a major wave of investment spending on decarbonization and clean tech and all of those things. And what I think is important about that is that if you look at the things that the global economy is going to be facing coming out of this cycle, the single best thing that can happen is a big wave in sustainability. So where there's a debate that people say we should be investing capital in what's good for the economy, or we should be investing capital in what's good for the environment, actually, in today's world, they are exactly the same.
What does that mean in practical terms? What kind of investments do you like?
Oh, well, you're seeing a lot of infrastructure in, step one in the extension, especially with the IRA coming in. Infrastructure in, renewables, in energy storage, in decarbonization, direct air capture and other, carbon capture things. There's also going to be a wave. We're working with a number of people in government to try and we need to get the SMRs, advanced nuclear, started, because there could be a big wave in advanced nuclear.
Firm. And here he is saying he expects dovetailing. He expects the second half of the year to be kind of flat. So, hey, you know what? Interesting. In other news that you're not supposed to see, Mexican TV reported that Mexican TV reports that dozens of U.S. AT-4 weapon systems, which were originally shipped to Ukraine, have been purchased by the cartels in Mexico. Now, how in the world did that happen? No, I don't believe that.
Cuesta aproximadamente $30,000.
So I play the audio, but audience speaks Spanish. Regardless, though, that can't be possible, right? That's not possible. Oh, well, I'm not sure if I trust BulgarianMilitary.com, but Mexican cartels, here's this article outlining. But I don't believe this happening, because that would be illegal. And if there's one thing I know, it's that this is not real, because that would be illegal. Okay, but anyway, back to some economic stuff. You guys, this is the last article I've got for you today. And inside the negative equity time bomb, U.S. homeowners have lost $100 billion in home equity this year, leaving more than 200,000 people at risk of going underwater if property prices fall just another 5%. Whoops. Who could have ever seen this happen? Especially, I really, really hope that a lot of people do not have, let's see, ADJUST. Oops, why didn't I adjust? Okay, well, they don't mention how many people might have adjustable mortgages. So, no, I don't see adjustable, but so here's this article. It's exactly what you think it says. Inside the negative equity time bomb, U.S. homeowners have lost $108 billion in equity this year, leaving more than 200,000 at risk of going underwater if property prices fall another 5%. Now, this isn't going to hurt you so much if you're one of those people that are actually buying a house long term and you plan on living in it for a long time. Yeah, you're going to get hurt up front, but what you can do is in a few months or years, whenever rates finally come down, you can refinance it and be probably okay. Um, but really, negative equity, that's like you bought a car for $50,000 and you have to sell it tomorrow for some reason. You can only sell it for 30,000. That's what's happening here is negative equity. Um, as long as your job is fine and you don't lose your job, you ought to be okay. But anyhow, your source of income, let me put it that way. So check this out. Here's the first chart. Average year-on-year home equity changes by state. So obviously we can see a lot of these places on the coasts, as we know, that lost lots of people. It fell, but here's Missouri. Oh, you know what though? That's crazy actually. I'm surprised Idaho is down 33,000 and Nevada because that's where a lot of people fled to. But you can see a lot of people into Florida and all over the South here outside of to get away from places like Connecticut, Massachusetts, other places. And then down here though, oh, it's the same chart. I apologize. So anyway, let me just read this. Let's not bury the lead. Homeowners are sitting on negative equity time bomb after losing $100 billion on their property values this year so far. The average borrower saw their home equity plummet by $5,400 in the first quarter of 2023 compared to last year, with households in Washington, California, and Utah worst affected. And if prices tumble by 5% or more, then 200,000 households could be at risk of falling into negative equity, otherwise known as going underwater on their home loans. Negative equity occurs when an individual's outstanding mortgage balance is more than the value of their property. Well, again, who could have possibly seen this coming? Everybody. But again, the last couple of years have been so absolutely bizarre that you got to do what you got to do. Some people didn't have a choice. You got moved for a job. You had a family murder. What who knows? But here's this one comment I'll read you. It says, anyone that bought a house in the last couple of years without a lot of equity had to be insane. The prices were so inflated. Of course, it's going to crash and put them underwater in the short term. Regardless, though, there's a lot of people that didn't have a choice. And, the other part to factor in is, and we're doing this in Kansas City right now, property value taxes. We have this massive drama in Kansas City right now where people's property value are increasing 25%, their taxes, their property taxes, 25%, 50%, 100%. And what's changed? Nothing. Just this exact little, event. That's the only thing that's changed. But your city and your county governments want that money. They want that tax money. So not only could these people be upside down in home equity, but they're also going to get absolutely hosed on their property taxes. And at least here in our area, property taxes reassess every 2 years. So you're going to get shafted for 2 years. Plus your interest rates are way high. I feel terrible for people who are caught in this situation right now. But you gotta do what you gotta do. So, okay, let me check the stream. Let me see. Hey, Reverend Walker, good to see you in the comments. Thanks for checking in with me. Let me see if there's any last couple of things that I wanted to go over with you guys here. Nope, there's that. Okay, I think that's about. Let's have a look here. Anything?
You move, the more you'll feel the support. Our most advanced.
I think that's about it for the live stream today, you guys. There's not a whole lot going on. I will show you. We've got a lot of reports coming in this week, various economic data. Let me see if I can find Cobe. Where was that? We've got a lot of people from the Federal Reserve talking this week. Speaking of housing affordability, I'm going to show this to you. Breaking as of this morning, the average interest rate on a 30-year mortgage rises to 7.15. This is the highest average interest rate since October of 22. For context, the highest back in 2008, 6.6. And yeah, absolutely, housing affordability has just hit a new low. I feel terrible for anybody that can't get themselves out of that situation and more or less have to buy a house. But other things coming up this week. Here we go. Okay, so today and tomorrow will be kind of quiet, but Wednesday, baby, CPI inflation data. Then Thursday, PPI inflation, jobless claims on Thursday, which again, we just talked about. Those have all been misread and misreported, so be patient on that. Consumer sentiment, big deal. And then, big deal, bank earnings. We have earnings week coming up this week, and you better believe we'll be doing some live stream to cover what those bankers are saying, because earnings every 3 months, they start coming out and talking about it. It usually always goes in this order: first the banks, then a lot of tech, then a lot of your grocery store consumer type brands, and then energy. They usually come out last. So we'll keep you posted on that stuff. But let me see. I think that's about all I got for you right now. I will catch you guys later. Again, thanks for tuning in, and keep in touch if you ever have concerns, questions, comments, or topics that you want me to go over.